Okay, you are welcome today as we look into smart money concept major candlestick formations. Okay, I believe by now, as I've shown in those videos on YouTube, that you should study trading, candlestick trading Bible. If you have studied it, good. If you have not studied it, no problem also. That is why I'm trying to analyze out. These are the important candlestick formation. You see, this one and this one here, they are called indecision candlesticks. This is how they form. The body of the candlestick is little. Then we have wicks on both sides, wick here at the top, wick at the bottom. The color does not matter. That's for that. The indecision candlesticks. Then when we come to this particular candlestick formation, we'll call it shooting star. That is when you are talking about, okay, so people that trade only price action, not a smart money concept, when they see this type of candle formation, it is called shooting star. But when it comes to smart money concept, we'll call it IFC. What is the meaning of IFC? It is called institutional funding candlestick. Because with that, when you have it at a particular point of interest, that's POI, after marking out your structure, and you see this type of structure, this type of candlestick appears, probably when it has taken liquidity, any entry you see there will give you high probability of playing out. You see, shooting star, and then this one is called hammer or pin bar, is also IFC. Okay, so this one will usually come from when you want to buy bullish trend. This one usually come for bearish trend. That is for that. Then we also have this type of candlestick formation. This one is called evening star, while the other one here is called morning star. You see, this morning star is for bullish trend, evening star is for bearish trend. Then we also have this type of structure also. This type of candlestick formation. You just have to know it. You will see that repeatedly on the chart. So before you know it, you will just get used to it. Okay, that is how these are the important, most critical candlestick formations we see in as much you are trading smart money concept. Now let's go to the main topic of today, which is single candlestick order block. We call it single candlestick order block, or SCOB. SCOB, S for single, C for candle, stick, O for order, and B for block. So single candle order block. What do we have here? We have our general market structure. In this situation, this is a bearish trend. How do we know it's a bearish trend? My price gave an inducement, price took it out, and then there's a break of structure here. Price formed another pullback. Then price was going to take out this pullback here, which is inducement. What now happened? You will know that this point is inducement point, but when price was coming to the inducement point, price can give us this type of candlestick formation, and we can remember this type of candlestick formation is called morning star, if I'm correct, or sorry, evening star. This is evening star candlestick pattern. This is what I just formed here, evening star candlestick pattern. Then this can be a high probability entry if the candlestick before the middle candlestick that we take out this inducement point, if it also took out the liquidity point of the candle before it. You see, this candlestick here, let me say candlestick A, the high point of it, which is the wick, this middle candlestick took out the wick by not closing above it. It just took out with the wick. Then price also, the wick of that middle candlestick also took out this inducement point. With that, we can, and then we anticipate price to close the next candlestick that will form, which is candlestick C. Now let's say this is candlestick A, the middle one is candlestick B, and then the last one there is candlestick C. This candlestick C, we have to close below candlestick B. With that, we can now choose candlestick B as our what? As our single candle order block. We can make direct entry here. Price, we just pray price will come, tap on it, and then begin to sell. Like put your sell, sorry, you have to just put your sell symbol there, and then your sell instrument there. Then you can sell it down to this low point that would have been confirmed. But if you want to have more confirmation with respect to this, you now go to the lower time frame. When you go to lower time frame, what model are we going to apply here? We are going to apply entry module 3. Not model, sorry, module. We are going to apply lower time frame entry module 3. And we can remember when we are studying our entry module, if you don't know about it much, you can check the YouTube channel. Everything I've uploaded there about the entry modules type 1, type 2, type 3. So in this scenario, we are going to apply entry module 3 for the lower time frame entry. Then what if price did not give this type of formation? Price just closed above this inducement point. Then when it comes to this decision order block, price can give all this type of formation. We can also enter using, but this time around we are going to use entry module 1 or entry module 2. If this type of formation also form on the extreme order block, we are going to use entry module 1 or entry module 2. Very simple as ABC. I believe as we do more case study, you will get to understand it more better. This is for scenario 1 that requires lower time frame entry. Entering this type of trade directly without lower time frame entry, it can play out, but it has less probability. So this is for scene 1. Now when we come to scene 2 about this, when we come to scene 2, in the scene 2 section, you see price gave us this type of bearish trend. You see this price taking out the inducement, but when price was making move to go and take out the inducement, price can give us this type of reaction. You see the first pullback did not take out, did not get to the point of inducement. It retraces a little, make a pullback, then it went up again. In the second move that it now moves, it took out this previous candlestick high, and the wick that took out the candlestick high is also the wick that also took out, that's going to take out the inducement point high. So with this, we have liquidity swept in 3 places, in three places. This candlestick high was swept, this candlestick A was also swept, the eye of it was also swept, this candlestick B swept the eye of this candlestick and this candlestick before it now went to sweep the inducement point. With this, we can use lower time frame entry module 3, or we can make a direct entry here without using any lower time frame entry. If you see this type of market structure giving us this type of price action, all we have to do, we can place our entry point there and enter the trade directly. This is what we call high probability trade. Why? Because 3 points liquidity taken: first point, second point, and third point. Okay, so with this, we do not need lower time frame we do not need lower time frame entry module. But if you want to use lower time frame entry module, it's also good, as we are going to have a lot of risk to reward. The risk to reward will be very, very high if you use lower time frame module. But you can also enter directly with this type of candlestick formation. Okay, so we also have, if we have this type of structure also formed on the decision order block, we can make direct entry or lower time frame confirmation. The same thing applies to the extreme order block. We can also make direct entry. I hope this is very, very easy to understand. This is what we call single candlestick order block, as it helps to give very good entry, as it helps to give very good entry probability for our decision to play out very well. Thank you.